Legendary hedge fund manager Barton Biggs' Traxis Partners returned 39% last year, 3 times the industry average. Now, when we spoke last time with Barton at the end of July, he said the odds of the world slumping into a significant slowdown had diminished, and he was starting to build up his equity positions again. Barton Biggs joins Matt and me. And Barton, what was kind of interesting is Matt and I talked to you, I think, at the beginning of July, and you were getting out of, I think you sold half of your equity holdings at the start of July, and then you became more aggressive at the end of July. So where are you now when it comes to the outlook for equities?
Well, I got whipsawed in July, but not the first time. And so where am I now? I'm still hanging in there. I'm fairly exposed, and I got a fair amount of risk on, and I still feel that the odds of a prolonged significant slowdown are, in other words, a double dip, are 1 in 5, something like that, maybe 1 in 4, but they're pretty remote.
Let me ask you, and I'm sure you sit around and think about this all the time, Barton. What are the biggest risks? I mean, the biggest concerns as you look at the possibility of a double dip?
Well, I think the biggest risks are that unemployment continues to rise, and I don't think it's going to. I don't think it's going to come down dramatically, but it could continue to rise. And then I think the other big risk is that the price of existing single-family homes declines at 5 or 10% precipitously in the next couple of months. And the numbers we got today were backward-looking numbers, so they don't prove anything yet as to what's going to happen to single-family home prices. And then that's where the average American, most of his net worth is.
I'm a little worried because I think about the 2 things you just said, Barton, and I'm looking at the unemployment rate, the forecast that we're going to get that number on Friday is 9.6%. That would be up from 9.5% the previous month. And when it comes to single-family homes, I mean, Matt and I've had a lot of guests on here who are talking about that there are going to be a lot more price declines and significant ones. So to me, that makes me a little bit nervous. I mean, are you very nervous about the outlook here, even though you've got a fair amount of exposure to risk and to equities at this point?
Yeah, I'm definitely nervous about the outlook here, but nevertheless, there's some other things that make me reassure me a little bit. I think that there's an awful lot of bearishness around. I think that big capitalization, high-quality stocks are very cheap, and we've had 10 lousy years. I don't feel like this is a time when I want to be really underinvested or net short.
Hey, I wonder when we were talking about our last guest, and he said he thinks it really does matter what happens in November as far as does another party win control of the House, the policy changes that could possibly result from that. Are you optimistic that something changes? Do you think we need to see a change? Do you think that the policy has been the problem here? I mean, what's your take on Washington?
Yeah, I don't have any great insights on Washington. I mean, maybe a hung government in the sense that the president is in a different party from the House and the Senate is a good thing. Maybe that's the kind of paralysis that we need, and maybe under those circumstances, the Republicans would be more inclined to pass additional stimulus. And I think the other part of the equation is that Bernanke has signaled pretty darn strongly that the Fed is going to do everything it can to make sure we don't slip into a double dip in deflation. And I think eventually the politicians will do more also. Now, whether you like that or don't like that for the longer term is another question. But I'm worried about the next, and I'm focused on the next 3 or 4 months, not the next 3 or 4 years.
Barton, something that we're focused on today is some news that came out about JPMorgan and that they're said to shut their proprietary commodities trading unit. They're planning to shut all their remaining prop trading desks. I know JPMorgan is one of your 10 top holdings. What do you think about this news from JPMorgan?
JPMorgan is one of our 10 top holdings, but what do I think about it? I mean, I think that it's the right thing. I don't think that commercial banks that are too big to fail should have prop trading.
You are and have been for a long time a supporter of the Volcker Rule, Barton.
Yes.
Let me ask you I mean, you're looking at the next few months, and there still is a lot of uncertainty out there that has to do with regulation. This is one of those things that we see coming across in the news. Do you think that it makes a difference as far as the next 3 or 4 months, how this regulation plays out, or do you think that that is too long-term to consider in your investment picture?
Well, Matt, I'm not inclined to think it's too long-term, and I think also the market knows that regulation is going to be tougher, and I don't see where JPMorgan having to spin off its prop trading is either bullish or bearish. I mean, it's the right thing for the financial systems and the world and America, and so let's get it done. But I don't think it has a big impact on equity prices.
Barton, when you look around at the equity universe, the investment universe, I mean, where do you find the opportunities at this point? You say you're taking on more risk. Where specifically?
Well, I continue to think that high-quality, big capitalization stocks in America, the multinationals, basically the S&P 100, are incredibly cheap. And beyond that, I think areas like oil service, like the REITs, different sectors are attractive. And then I continue to feel that the emerging markets are where the growth is and is going to be, and that means particularly Asia. And so I've got a very, very high percentage of the portfolio I'm responsible for in the emerging markets and particularly Asia.
Let me ask you about here at home, Barton, because you and I have talked about at length the rule of 20. And if you take 20 and subtract the interest rates that we're looking at, the benchmark rates, you still have 20 left over. Subtract inflation expectations, you still have 20 left over, and yet we're seeing multiples of 13. Do you think that's an extremely bullish signal?
Well, Matt, and as you and I have talked about also, there's this thing called the Gibsons Paradox, and a Gibsons Paradox says that as you get close to deflation, in other words, when inflation, and it's measured by the CPI, gets down to in the area of 1% or less, everything flips.
Got it.
And that instead of lower inflation and lower interest rates being bullish, they're actually bearish.
Got it. All right. Hey, Barton, thanks so much for joining us today. Barton Biggs from Traxis Partners. We got to take a